Welcome back to another Market Open live stream. Well. Today the market appears to be red, and it looks like the reason for this appears to be the likelihood that jobs data just came in stronger than the market was expecting. Not the official jobs data, but private jobs data reports. Now, here's why. Excuse me. Okay, so my belief is we've had and we've mentioned this on the channel before, but I'm going to give a quick little recap here. So private jobs data, ADP jobs data comes out on the Wednesday prior to the actual jobs report. Actual jobs report comes out on Friday. The ADP report is seen as sort of a tool for potentially estimating or guesstimating what the actual jobs report will look like on Friday. The jobs report came in higher than expected, and this is no surprise because in addition to unemployment benefits wearing off for those off of or out of work, we are also in a situation where when you got into August, which the last jobs report we had was released in September based on August data. When we moved into August, we had a lot of fears about the Delta variant taking off. And those fears have mostly subsided. So you kind of have these two big factors that explain why it would make sense why the jobs report would come in higher. You've got the waning Delta, while at the same time reduction in unemployment benefits. So when you combine these two things, it makes sense that all of a sudden hiring went back to boom time in September, and that we saw the jobs report, at least private jobs report so far, increase for September, which was just released today. We expect the same thing on Friday for the regular jobs report. And we think that this is going to be sort of the nail in the coffin for the tapering actually happening. It's possible that the stock market is reacting to this thinking, oh, great, this means the taper is actually going to happen. And if the taper actually happens starting in November, then that cheap, easy money kind of goes away. And it's still going to take a while. It's still going to take until the middle to end of next year to fully taper. But the taper is seen as something that takes some buying pressure out of the market for stocks. As a result, though, you are also seeing cryptocurrencies move nicely. And that's likely because cryptocurrencies are moving on the thought of, okay, well, an expanding economy or a strengthening economy could actually be beneficial to a currency like Bitcoin versus something like the U.S. dollar when we're doing our taper. See, now a taper. Well, let's try to explain this because this is a little tricky. The taper, in some sense, could actually also be good for the dollar because when we taper, we're going to have less dollars, which makes the dollar potentially more valuable. It would lead bond prices to generally fall, driving yields up as inflation expectations or higher rates are expected, and inflation expectations potentially move up. So you've got bond yields that end up going up, making the dollar more attractive and potentially making just currencies in general more attractive. The overheating, though, or I wouldn't say overheating, the growing of the jobs report, though, and jobs data could potentially be an indicator that we end up with higher inflation readings, perhaps. Who knows? And that's maybe the rationale for that could be if we have more hiring being done. Maybe that means that hiring is being done at higher wages and potentially indicates that longer lasting, more persistent inflation than previously expected. And maybe that's why we're starting to see crypto go up. So kind of a little bit more of a complicated situation there, but hopefully I thoroughly broke that down. And so we've seen Bitcoin move nicely here over the last few days. We've gone from the lower 40,000 range not that long ago here. I mean, take a look at this trough here in the third week of September. This trough, by the way, was really a function of the Evergrande crisis. If you remove this trough, you can see we're much more on that trajectory of growth where we were before, except it was just kind of delayed by this whole Evergrande debacle here. And so this created a nice little opportunity to reduce your cost basis, which I did do. I sold my crypto and rebought it lower, which was nice. And Now I think those catalysts keeping crypto down have actually been removed, and I think now we have more positive catalysts to look forward to, like in 2022 when we get more positive regulation or just regulation in general around crypto. Yesterday, I made a video about Camber Energy, explaining why it was falling. It was down 50% yesterday, presently down about 23%. We've got Meta Materials, also down about 5%. Smile Direct Club down about 4.6%, rotating after that 15% gain yesterday. Moderna down again about 4%, 4.4%. That Merck drug really weighing heavily on Moderna here. Had a nice run on Arrival yesterday of about 3%, but giving up more than that today. American Airlines up about 1/3% yesterday, down 3.28% now. Looking at gainers, you do have great news out of Palantir. We touched on this yesterday. The new Army contract, Palantir, great news, part of a second round of this same line of work, same line of contract. In fact, here I have a little bit more detail on it. We can review in just a second. Let me see here. Okay, here we go. Here, this will take me just a minute. So let's go ahead and jump on over to Jim here for a moment.
To Facebook here in the A block as Mark Zuckerberg does strike back after whistleblower Frances Haugen testified on the Hill yesterday. In this blog post, he says, quote, "At the heart of these accusations is the idea that we prioritize profit over safety and well-being. That's just not true. The argument that we deliberately push content that makes people angry for profit is deeply illogical," Jim. He says, we make our money from ads, and advertisers consistently tell us they don't want to be placed next to that kind of content.
That's absolutely true. I think the more important issue with advertisers, by the way, is whether you can do third party now that Apple's changed the operating system. I don't really.
All right, let's touch on Palantir for a moment here. Let's see what we got. Okay, so Palantir yesterday was up about 0.17% to 24.85. It's up a little bit more now. Let's see here. I put together some notes on this, and we did touch on some of this yesterday. Just give me 1 second here. I'll talk a little bit more about it. All right, there we go. Okay, here we go. So, okay, so let's just briefly touch on Palantir. So, yeah, yesterday Palantir released a news that they were selected by the U.S. Army Program Manager for Intelligence Systems and Analytics to deliver the Army Intelligence Data Fabric and Analytics Foundation for Capability Drop 2. There was some talk about this being an indefinite contract because that's what they phrased it as. And yesterday we looked into what this indefinite contract actually meant, and it really just means that when you have an indefinite contract, it's a fancy military term and government term for basically saying, hey, for a period of time, for 5 years and 4 months and a total value of $824 million, the U.S. Army would have infinite access or indefinite access to the Palantir platform. And kind of fascinating to think about contract negotiating like that. But that's one of the reasons Palantir is running right now. Up only 6% right now because the market's pretty red more broadly. Yesterday, when this was announced in after hours, the stock did go up about 13%. And this particular contract is the second phase of an existing contract that they already had. And in theory, the Army could have gone to a different company, but Palantir was already involved in phase 1. And so I suppose it makes sense that they went to Palantir for the second part. And it's always interesting when you kind of read about Palantir because there are a lot of people who are super bullish on it. There are a lot of people who are who think the company is overvalued. Some folks think this is easily a $40 to $50 stock. Some folks are a little less optimistic about it, but personally, I like it. One of the most difficult things about it, though, is getting insight into how much winning a contract like the Army contract really helps versus losing a contract like potentially the ICE contract. Now, we could always look at the dollar value, but something that I like to look at when I look at contracts is what is the potential recurring nature of that? See, like Palantir losing an ICE contract potentially doesn't just mean they lost that one set of dollar value, but it also means all of the future recurring revenue that they could have gotten from that relationship with ICE potentially now goes to a different company, like whether it's Raytheon or whatever it is. And so I think there's some longer term implications to losing deals. We don't want to see deals get lost, but it is nice to see some excitement again for Palantir, bringing them up right now to let's see here, 24.74 is where this brings the stock price up to right now. And again, yesterday and after hours, we're up about 13 to 14%, but we have a pretty red market right now. In fact, let's go ahead and look at the indice futures and 10-year treasuries here. Let's just see where these stand. Okay, here we go. Okay, so right now we've got the Dow Jones down 0.82%, the S&P down 0.93%, NASDAQ down 0.98%. The 10-year is actually still relatively stable at 1.521. What's interesting is more and more, even though we have these beliefs that inflation is going to be here more persistently than previously expected, still inflecting at some point in the future, but likely to last longer than expected. Despite this, we're really not seeing a skyrocketing in the 10-year like we saw at the beginning of last year. I'm sorry, the beginning of this year. 10-year treasury. Here we go. Let's take a look at this. Okay, see, at the beginning of the year, we had this sort of crazed run, and this really led to a sharp sell-off in technology stocks. And sure, right now we have had a run back up. And while that is true that we've had this run back up, we've really been stuck under this sort of 155, 152. You've got a couple resistance levels here. We've really been stuck here. So I think it's interesting how the market appears to be indicating that the inflation that we have is probably the inflation level that we're going to stay at, and that's going to be elevated for longer. Hence, bond yields pricing this in. But and the stock market obviously being somewhat sensitive about any kind of swing, like the jobs data that we just talked about. But beyond that, we're not seeing massive negative catalysts coming. More what we have, in my opinion, are positive catalysts. The resolution to the debt ceiling and the infrastructure package, I think those are positive catalysts. The Evergrande debacle has mostly faded at this point. We have, beyond the Evergrande debacle and the debt ceiling and infrastructure crisis, really the only remaining thing is the Federal Reserve with tapering and inflation data. And I feel like we're almost on a set path for that. Begin the taper November 4th, end it somewhere between the summer and fall of 2022, and then begin raising rates once in 2022, twice in 23, and 3 times in 2024. Seems like a pretty clear path. The stock market's still relatively nervous, though, because we don't have all of those answers yet, and we do expect more of those within the next 2 weeks. So this volatility here leading up to October 15th through October 18th, my opinion, kind of to be expected. So let's go ahead and take a look at BPTC USD again here. Yeah, look at this run in Bitcoin right now. Absolutely incredible. Very nice run in Bitcoin. Let's see here. My let's see here. Hold on. My real belief is that this is your definition of the China crisis going away. This is what we believed was the big negative catalyst for crypto in the first place, and that is now escaped us. Yeah, I wonder though. Let's see here. Fine on the 5-minute chart. We really just took off just now. Look at this, folks. This is about, let's go to the 1 minute actually. Yeah, this is the 1 minute here. It's really been in the last 3 minutes. It looks like we all of a sudden had sort of a heavy buy set here within the last 3 minutes. Yeah, this is incredible. So within the last 3 minutes, we have gained roughly $2,000. I'm sorry, almost $3,000 at one point, but now down to about $2,000 in gains in about 4 or 5 minutes. That's a nice spike here. In my opinion, that represents institutional trading moving into the stock. It's also fascinating how we broke through this resistance level, and now we moved almost immediately to slightly above the support line that we have here, because we're sitting right here, which is the same as that resistance line. Palantir is still moving, up about 7 to 8% right now. HUD 8 mining moving up as well, 4.27. Coinbase coming back up a little bit, 1.44. And otherwise, most of the smaller cap stocks selling down, including Matterport here, down 2% in the pre-market. SunPower 1.85, Lucid 23.53, Enphase sitting at 145 again, really getting stuck here. DocuSign 252, nice drawdown here on DocuSign continuing. Another opportunity to add. Airbnb sitting at 141. We're almost back at IPO pricing here. My goodness. Let me see here. Oh, I'm sorry. Airbnb's at 164. I misread that. I was going to say, that's I can't believe it got that low already. Yeah, I misread that. I must have read Alibaba. Whoops. Wynn Resorts, Etsy. These guys down as well. Tesla's also down. Tesla, Apple, the FANG. Yeah, there's Apple. Apple down 0.87. Tesla down 0.61. And really eyes right now on Bitcoin for running right up, right through. Look at that run. It's kind of like we took off from our support over here. Look at this shelf that we really sat on right here. Sat on the shelf, started rising, and all of a sudden we got the traders, boom, bring it right up to the line. That's roughly where we sit right now is this line, although we do have a little bit of selling down as you react to this quick breakout that we had here. 54,300. That's where we sit now. All right, let's go ahead and look at some of the news of the day and see if we can get a little bit more insight into what's going on. All righty, let's see here. Okay. So let me see quickly what some of you were saying here. Last week, I was worried that my portfolio was too crypto heavy. Well, now you don't have to worry about that one. Yeah, good job on BTC. Lucid about to open at a 12-day low. Yep. What's your question, Daniel? Chinese has a minor problem with their economy. Is that like a pun on like mining and but also being small? I believe the Chinese do buy a lot of Bitcoin. I think they're one of our top 5 to 7 countries in terms of crypto ownership. And when's the Hippo video coming out? I already made a Hippo video, but I don't have plans for another at this point. Okay, good. Let's go ahead and take a look at some of the news going on. So let's see. Okay, here. Read the runes. Inflation is showing staying power. Well, let's take a look and see why inflation is showing staying power, at least according to Bloomberg. Now, I want to make this very clear before we talk about inflation's staying power and the runes of inflation. I think is an interesting reference to mythicness and video games. I want to make it very clear. I believe that I've been extremely consistent that inflation is something that would skyrocket thanks to base effects. That is, comparing to the whole of last year. This is something that I've been talking about since November. One of the first people to warn that we're going to have massive clickbaity levels of inflation in the summer of 2021. That inflation ended up coming slightly earlier, or at least the fear of it started getting priced in rather than in April and May and June, as we originally anticipated. It really started getting priced in February in expectation of what would happen in April, May, and June. The expectation was that inflation would rotate down, inflect down, not disappear, but inflect down sometime in September and October. Inflationary readings, which our first one of these come out on October 13th. And when we would have this inflection to the downside, the hope would be that the stock market would rally under the realization that, okay, finally we're rotating to the downside. Now, there is this unfortunate possibility that this timing is wrong and that it's going to take longer for us to see that inflection to the downside, at least a sharper inflection on the downside. See, in my opinion, if we're at, let's say, 5.3% year-over-year inflation, and then next month we're at 5.2%, and then next month we're at 5.1%, we're really at a high shelf of gains, and we're staying high. That's bad, right? What we really want to see is inflation go down, like, substantially. And we want to see readings coming in at like 4.7, 4.2, 3.5, and a rapid deceleration in inflation. That's what we're hoping for. But unfortunately, as I discussed in a video yesterday on inflation, we have a lot of issues that are getting worse, not better. Consider the fact that supply chain issues, even though companies are dealing with them better, even though we're investing more in factories and manufacturing and hiring to try to deal with some of the inflationary headwinds that we have, we're still facing the risk that supply chain issues are going to last longer. Used car shortages are going to last longer. Labor shortages, as individuals retool, are going to last longer. European gas prices just surged again, bringing natural gas prices up 60% in just 2 days. Commodity prices at all-time highs. Lumber prices slowly starting to climb again, right? These are all things that we've got to look at when we consider inflation and consider, look, those gains aren't going to last forever. So the thesis is still correct. The problem is, and we don't know yet because October 13th hasn't come yet. The problem is, or are we actually going to see inflation lasting longer than expected? And right now, the answer to that appears to be yes. Now, we're going to look at this Bloomberg article here on, it is an opinion piece on why inflation might have more staying power, but I just quickly want to throw this chart up. I keep throwing this chart up here. Shout out to Bloomberg for this, obviously, because we could see the expectations for inflation here. And we could see that by Q3 2022, we really expect to be back at around that under 2% level of inflationary readings. The problem is that that bump there, that hill, could end up being a lot wider than expected, and that we might not, that whole left side decline there might end up shifting over by a quarter, 3 months, 4 months, 5 months, 6 months, who knows? And how fat it is really the question here. There is no question that inflation will end up being transitory. The question is it going to be, is that inflection at the end of this year, or is that inflection at the end of next year? It's a difference of potentially a year, which is not so great. That's a big difference. All right, let's go ahead and take a look at what this op piece in Bloomberg shows here. So this op piece here says a test for the Fed. And this is by John Authors. He is a senior editor for markets. Before Bloomberg, he spent 29 years with the Financial Times. So he is an author, a writer for papers. He's a journalist. And he wrote an opinion piece here. How worried about persistent inflation should we be? And look, it's easy to make fun of the Federal Reserve, like, oh yeah, sure, inflation's transitory. We get it. Like, everybody makes fun of the Fed for that. That's fine. But in the long run, when we look at, again, the chart that I just showed, it's going to be right. At least that's what we believe. Who knows? Maybe it just collapses and we go back to the 1970s. But I think that's more like a 10% case scenario. What is much more likely in the 90% direction is that we are going to have temporary inflation, but we just don't know when that big inflection is going to be. It's going to be this fall, in the spring, in the summer of next year, in the fall. We'll see. Obviously, the hope is sooner rather than later. But anyway, how worried should we be? And perhaps more to the point, how worried is the Federal Reserve? Digging into the latest data suggests that the risk of persistent inflation are increasing, while shifting policies in DC suggest that we may soon have a new and relatively unfamiliar senior team at the top of the Fed to interpret the data. The following charts come from Alex Pell, a U.S. economist at a financial group. Last week, personal consumption expenditure, PCE data for August, were initially hailed in the market as showing inflation pressures were reducing. Pell argued that they show the opposite, that inflation rose slightly on a month-to-month in August basis compared to September. I think they mean compared to the month prior. Because we don't have our September data yet. Anyway, even though there was a reduction in the contribution from restaurants, air travel, and hotels, three sectors that should benefit from the post-pandemic reopening. So anyway, in other words, the headline data showed a slight decline for PCE inflation. But when we looked at the month-over-month data from August to September, we saw this slight little kind of tick up here. And that month-over-month tick up is something that that's a little bit more concerning. Meanwhile, look at the broad categories of the PCE basket, found that most were distinctly above their typical range. Let's take a look here. So this is the personal consumption expenditures measure of inflation. And this here shows, if we take a look at some of the month-over-month ones here, larger gain here, 0.4% in the total gains here. Goods still increasing on a month-over-month basis here, 0.21%, larger than the prior month at 0.15. Services coming in at 0.19, a little less than that 0.25 prior. And this is services is something that really has the capacity for bumping a good chunk here. So there are going to be a lot of eyes on services. Okay, let's get back in there. Here we go. Okay, meanwhile, look at the broad categories found. Okay, we read that. Beyond digging into the official data, Pell also contributed to the growing industry of looking through the Fed's archives for every last piece of research on inflation, hoping to find clues. This yields research by the Fed into cyclical and acyclical inflation. Acyclical inflation arrives in the form of sudden shocks and will be transitory. Cyclical inflation, tied to moves in the economic cycle, will be more steadily and slowly, will move more steadily and slowly, and will be much harder to bring down. Ooh. Acyclical inflation actually went negative early in the pandemic, then shot to the highest level. This confirms the transitory talk. That's good news. The bad news is that cyclical inflation has now taken over. Oh, look at that. Acyclical inflation taking over here versus cyclical inflation. Cyclical inflation taking over versus acyclical. Cyclical inflation is now at the highest level since 2006 before the financial crisis. To the extent it's positive, is a symptom of the recovery in the economy. But such a sharp increase from already high levels is unusual and suggests the Fed should be careful. Ooh, this is interesting. Let's talk more about this in just a moment. Let's go ahead and get the bell here and see how the market opens. And then we'll come back to some of these differences between acyclical and cyclical inflation. Fascinating. Let's listen in.
Rates are going up a little, but they're not that bad.
But you don't think it's a rate story?
No, I mean, I wish people would stop talking about the rate story. I got a 3 1/4 I'm getting, and believe me, it is not a favored treat because I do not have a regular so-called paycheck because I'm a contract employee. So I'm getting what everybody gets, and if you're fighting for the money, plus the process is 4 months.
Whoa!
It used to be 4 days.
That is really red. Look at that. That's like over 95% red.
I'll give you everything you need. It's not enough. Yeah. It's not enough.
All right, let's take a peek here at how things are actually opening quickly, and then we're going to go back to that article because it's actually quite fascinating. So some volume here at the start on the S&P. Looks like that volume is actually pushing us down a little bit. We jump on over to the Etsy chart. We have a slight green chart here. Volatility index up. Palantir rotating down at the open. Looks like some profit taking on fears here. We do have Hut 8 Mining moving up nicely, which is very good. Let's get to our watch list here, and I'll look at some of the changes here. Blue Apron actually moving up nicely at the moment, at least. Oh wait, where did it go? That may have been a glitch. Where'd it go? Blue Apron's gone. Anyway, the miners, Marathon, Riot, Hut 8, these guys moving up nicely. Coinbase coming up about 2.75. Really just crypto-related assets moving very, very nicely here. Looking at the downside, Camber Energy actually pairing some of its losses. Nice actually gains here. And let's see if this ends up leading to a rebound. One of the things I mentioned yesterday in the Camber video is that momentum stocks, when they do suffer these massive drawdowns of sometimes 70%, they get to these low levels where folks are like, this is cheap relative to where we've been used to it. Let's buy the dip. And so I would expect that there's a little bit of buy the dipping going on here. Just remember, when you are trading in Camber, you're trading. At least I believe you're trading. I don't believe people investing in Camber are really looking at the fundamentals going, oh yeah, this is very nice. I don't believe that. All right, let's see here. Workhorse, Proterra turning red. Root Insurance Company, red. We've got LiDAR, red here. We've got Wish, also moving red, but starting to show a little bit of green. Let's see here. Cheesecake Factory, how are some of these doing? Red with a little bit of green coming. Enphase. Let's see if we can pull Enphase here for a moment. That's JD.com. Here's Enphase. A little mixed at the start, sitting at 144. How are some of the FANG names doing? Google actually turning green here. Then we've got Square turning green. Let's see if that means the SPY is trying to start rotating up. Yeah, it is. It is. Looks like we're getting a little bit of that buy the dip happening here. Affirm also showing that sort of green here. So the market does appear to be picking up the buy the dip movement here, which if you want to pick up to $70 of free stock, make sure to go to metkevin.com/public. They won't buy or sell your information, and they don't use payment for order flow. So go to metkevin.com/public to sign up for public and get up to $70 for free. That link is right next to the link down below for the programs on building your wealth. You get 41% off with that Diamond Hand coupon code. All right, so a little bit of recovery coming to stocks right now, which is going to bring us green to some more things. We've talked about a crypto catalyst here, potentially being the stronger jobs data in helping reiterate that potentially inflation is slightly higher and potentially more lasting. And even though we get more hiring done, this could potentially squeeze jobs, leading inflation to rise. And with more hiring we have, the more we actually reduce the available supply of other workers, leading to potentially wages to go up even more, right? That's sort of the argument here. But let's jump in just beyond crypto for a moment and go back to this argument. So let me catch you up. So we've had this discussion here about how inflation appears to be transitory for longer. That doesn't mean that it's wrong, that it won't be transitory. It's just here for longer. And there's this Bloomberg opinion piece where individuals have gone through some of the Federal Reserve archives, and they've discovered this difference between something known as cyclical inflation and acyclical inflation. And what's important to know is that what ends up happening is we have the situation of acyclical inflation being something that can be transitory. And acyclical inflation has begun to fall from its peak. The bad news is that cyclical inflation is taking over. And when we think of acyclical, just associate acyclical with transitory and cyclical with not transitory. That's what they're suggesting here. And so while we're seeing the transitory one go down, which is good, we're seeing the one that's not transitory go up. And this has really started in the latter part here of 2021, really beginning about 3 months into this year, but continuing now. And so let's move on over here. Cyclical inflation is now at the highest level since 2006, before the financial crisis. And to some extent, this is a symptom of the recovery, but it's also increased at a sharper rate than the recovery that we've seen in 2020. Now, if you put this together with sort of other indicators from the Federal Reserve, The opinion author here suggests that it's easy to put together a narrative to explain why the central bank's sharply more hawkish or has been more hawkish in the last few weeks. And in the last few weeks, we've seen a Jerome Powell that's much more like, we're going to taper. We've met the conditions for substantial further progress. It's time to start tapering. And so the argument here is that if policymakers are reading the metrics that their own research departments are talking about, then we all find reasons to be more hawkish on the economy and potentially reduce that monetary support. Beyond looking into policy of research departments, calling how the Fed will react to inflation over the next few months also requires that predicting who will be heading the institution. Well, this is interesting because there's talk about potentially Jerome Powell not being renominated because you've got folks like Elizabeth Warren freaking out over him. I'm not so worried about somebody else taking over. I think the transition right now would be a little crazy for the Biden administration. So we'll see. But like it says here, bettors are probably right that Powell remains, they're talking about predicted odds. Bettors are probably right that Powell remains the clear frontrunner and President Biden continues to voice confidence in him. But the fact that the president needs to say so out loud demonstrates that the last few weeks have weakened Powell's position. Also true. On the subject of growth, another regional fair in Atlanta, or another regional Fed in Atlanta, has attracted growing attention for its GDP Now forecast, which attempts to capture how fast the economy is growing in real time. The latest revision was slightly unwelcomed, a cut in the current growth rate. Yeah, look at that. If this is GDP Now, and we're seeing a nice decline here in GDP growth, that potentially means you're facing more of that stagflationary risk, right? Where you're seeing inflation lasting longer, especially cyclical inflation pushing us up higher, with inflation being maybe the reason why inflation is sticking around longer. At the same time, an economy that's growing slower, it's potentially stokes those fears of stagflation. Oh, there it is. This still isn't stagflation, right? Because we're not quite there yet. But there we go. A combination of slowing growth and what looks like an increasingly durable rise in inflation would be a severe test for any central bank. If it turns out the Fed gets new leadership, the historic record suggests we can expect to have a few serious miscommunications with the markets in the first few months. This I don't think we would want to see, is having a different Fed chair with potentially different policies and a different way of communicating those policies without us being as familiar as Jerome, as we are with Jerome, could lead to some heart palpitations for the market. So with stagflation concerns back on the loose and egged on by problems with fuel, like literally natural gas and oil, this has been a useful juncture to receive the monthly download of the ISM Purchase Manager survey. With numbers above 50, remember we're expecting expansion. Quantitative news is good, at least if you're worried about stagflation, right? Because we have more growth at manufacturing. But let's see here. Purchase Manager Index, including those for the world, the Eurozone, Japan, the UK, China, compiled by market, remain in the positive. Again, good for growth. However, questions asked of managers about pricing say that in general, we continue to face price pressures. We touched about this as well in my inflationary video in terms of why we're seeing inflation potentially lasting longer. But let's see here. Ocean freight delays, delivery and availability of raw materials, customer demand continues to swell. Still amazed by the labor market. We used to have 100 applicants for an opening. Now we're seeing 10. And often the applicant does not show for the interview. My goodness. Our company's entire supply chain continues to have significant challenges getting manpower, which is adding to production delays, basically. Stagflation per se looks unlikely on this basis. Inflation caused by shortages of components and labor looks to be a real risk. And this is why we're seeing that inflation lasting longer. Thanks to those who have contributed questions. Okay, let's see what else we have here. As a result, everybody who wants to be successful as builders of new technology companies wants to work with those who are the very best investors. Demand exceeds supply. Venture capital is not known about the money. So what are they suggesting? There's a shortage of venture capital? I can't imagine there's a shortage of venture capital, but maybe there's a shortage of some of the leaders or the best names in venture capital. High demand for the best names. Survival tips. Okay, so what do we got here? Let's see. Sports analogy. Listen to Frank Sinatra. Really? That's their survival tip? Okay, I'm very interested in this discussion on the difference between acyclical and cyclical inflation. And what I really want to know is what drives cyclical inflation more. And so let's see this. Let's do a quick look here. PIMCO's got a piece on this. So cyclical inflation. Where is it? Really? Okay. Cyclical outlook. No, they're not really helping us. Okay, here we go. The Federal Reserve Board actually has a discussion on this. So this is their chart on this. And I want to see what's contributing to the cyclical aspect. Let's see here. Cyclical contributions. Okay, here we go. So here we go. What is this? Cyclical contribution is blue. And then they have healthcare over here. Okay, here we go. Hold on. Chart 2 shows monthly PCE price inflation as a combination of cyclical, blue, and acyclical components, green. That's interesting. So you actually really see a spike over here. Not so much. That's confusing. Here it's showing acyclical jumping, but that's not what we're showing over here. Why do they got to make it so complicated? That is so weird. Okay, let's briefly try to understand this, and we're going to jump on over to the sticks here. Look at this. Personal consumption expenditures, one of our tracking tools. Okay, the data on this page divide categories into cyclical, acyclical. Cyclical components are where prices tend to be more sensitive to economic conditions. Acyclical are more sensitive to industry-specific factors. Okay, so cyclical meaning everything, acyclical meaning specific industries. If the relationship between the unemployment gap and category's inflation rate is negative and statistically significant, the category is considered to be cyclical, not acyclical. Okay, got it. So that's how they calculate. So the figures show, due to the large size of the healthcare services within a cyclical measure and its dependence on administered prices, the contribution to acyclical is divided. Okay, got it. All right. It's just weird. It doesn't make sense to me. Why is acyclical here inflecting down, but here they're showing it inflecting up? Unless the time frame is different here. Not really. That is weird. I cannot make sense of this yet. So we're going to come back to this because this is pretty interesting. And this is probably going to be something that begets making a more detailed video on. But anyway, let's go back to the sticks for a moment. Because their breakdown's a little bit complicated, and we'll figure that out. But let's go back to what we've got actually happening in the market here. And it looks like despite the fact that we started out with a nice dip, we've actually gone back to some gains here. Take a look at this. Affirm, after a green day yesterday, up 3.58% again. We saw some red for the first 2 minutes in the SPY. And it looks like we went green right after that, and we've kind of flattened a little bit. So we've actually got a lot more things going green here. Look at that. DocuSign actually going green. It was just at 252 within the last 10 minutes here. Trade Desk's going green. DD's going green. Lucid's going green. Matterport's going green. A lot of the things that were red at the open here are green. That Tesla was down 0.8%, and it's going green here. NEO going green. Still sitting at 34. So still lower than where it has been. Same thing with Enphase, still lower than where it has been. But again, showing the resilience of the market. Fascinating. What an incredible U-turn here. With the exception of some of these smaller cap companies here. Camber, some of the recovery stocks, like the airline stocks still rotating down. Owlet still rotating down a little bit. That bad news on the FDA. I think that FDA news, by the way, is way overblown. So I definitely bought the dip on Owlet. We've got Meta Materials, Hippo, Wind Resorts, Canadian Solar. Okay. Dutch Bros, Disney. Some more recovery moving to the downside today. All right. Let's get back to some of the other news headlines. We'll come back to this discussion here about why we're seeing economic wide inflation versus just sector-specific inflation. I think it's an interesting argument, but I think the bottom line is more inflation here for the time being. Unrelenting political brinksmanship edges U.S. closer to default. Political brinksmanship is something that we seriously deal with almost every single time we have these negotiations on the debt ceiling, and it's just kind of exhausting. Or anytime we have political packages that need to be passed, for some reason, Congress just wants to edge every single package that we have. I don't know why they do that, but I guess they got to work on their re-election bids. Bank of America bumps its minimum wage again on the way to $25 an hour. The latest increase to $21 keeps the bank on track for its 2025 goal of $25 an hour. Wow. All right, so let's see. What we got over here? Let's go back to the Evergrande crisis. All right, back to Evergrande. Let's take a look over here because, in my opinion, the Evergrande crisis abating is really good for crypto. And that's why I invested more into crypto than what I even previously had into crypto as the Evergrande crisis started inflecting to be less fearful. And so what do we have here? China's property industry has suffered its first default on a dollar bond since Evergrande sunk deeper. And this was Fantasia. We covered this yesterday. It's interesting that that's being brought about again today. This company develops high-end apartments, and urban renewal projects failed to repay a $205 million bond that came due Monday, prompting a flurry of downgradings. But this is a relatively small company here, so I don't think anybody looks at this Fantasia issue as something that's actually going to create any kind of contagion in the market or really even any kind of fear. Creditors are now scanning debt repayment calendars as they try to suss out where the next flashpoints across an increasingly strained property market may be. Yeah, well, as long as they're smaller firms and the Chinese Communist Party continues to cooperate with developers at the local level, we're going to have a limited risk of contagion here. In fact, I think I saw something exactly on this here. Let's see here. Where were we? Yesterday, we had the president of Hong Kong speaking, and I was watching this quite a bit. Yeah, because you've got the same thing happening in, well, a lot of these stocks are obviously listed on the Hong Kong Stock Exchange. Some are cross-listed over to Shanghai. Let's see here. Okay, Fantasia's missed payment provides a clear sign that despite piecemeal bailouts of select Evergrande assets, property markets remain stressed. The rot is unlikely to stop here, right? But the other thing that was within this research I was doing yesterday indicated that we still have very strong local municipalities in China, because you could have, if you start having weak cities in China, then you potentially, in my opinion, lead to more contagion risk. Because if cities start failing and the real estate developments start failing, and then there's no city to bail them out, that's when you start getting larger issues, in my opinion. And so far, we're not really seeing that. So this we talked about a good chunk yesterday, so we're not going to talk about it again right now. All right, let's see here. What else do we have here? Check out a Forbes article. Goldman flags 8. Okay, let's see. Goldman Sachs 8.2 trillion risk. Let's take a look at what you got here. This is from September 30th. Okay, let's get rid of the ad if we can. Nope, there we go. All right, perfect. Go away. All right, what do we got here? The real worry concerning China Evergrande default drama is inevitable. Where there's smoke, there's fire paranoia that accompanies the death stumble. Most worrisome is surging local government debt levels. This is interesting. This is counter to what Bloomberg was suggesting. Surging local government debt levels that Xi Jinping's men may have done their best to hide. Default troubles of the globe's most indebted property development seem like small embers compared to the $8.2 trillion worth of local government financing vehicles outstanding. And that's just what we know of. It's an interesting point that if the cities are heavily indebted, then any trouble brewing for them again spills over. Now, so far, then there have been a lot of eyeballs on this. People and analysts are suggesting stability, but who knows, where those suggestions are coming from, and are they accurate? But they're right. That's exactly why this is a good reference. Thank you for sending this to me, because this is exactly something that you do want to be careful of, is how solid the municipalities are. Local government borrowing schemes scratch at another. Where there's smoke, there's fire worry. China's massive shadow banking universe. To be sure, China's government, as part of the efforts to rein in shadow banking, has taken aim at more than $1 trillion of opaque products marketed as low risk and high yield. All too often, these cash management products have channeled money into riskier borrowers, such as developers. Right. In June, the People's Bank of China and China Banking and Insurance Regulatory Commission restricted such products from buying bonds rated lower than AA. Okay, second level of debt. Loss of flexibility could create problems in the short term. Okay. All right. No particular suggestions of issues beyond the fact that there's potentially a lot of debt. But I think the question becomes, what are the historic levels of this debt? 52% of Chinese... Okay, let's see here. Chinese debt to GDP. Okay, let's see here. These charts show a dramatic increase in China's debt. What time is this? This was June 28th. Let's see what we have here. Okay, where are the charts? Here we go. Total debt to GDP. Well, this makes sense. China's gone up just like every other country. Breakdown of China's debt. Okay, here we go. China's domestic debt. Government, general government borrowing, household borrowing, non-financial corporations. What is a non-financial corporation? So this would be any company, basically. Got it. Makes sense that they're the largest. I mean, that could be like property developers because they're non-financial, right? China climbs in the world's economic ranking in nominal dollars in USD. It's kind of cool. This little sliding scale here. Okay. Chinese. Wonder if we can look up Chinese municipal debt. Let's see here. So this Reuters article says local government debt sits at $3.9 trillion. Why did they say $8.2 trillion? That's interesting. Local government financing vehicles. Massive hidden debt. Okay, so maybe are they thinking that there's more? The default troubles at the globe's most indebted property developments seem likely small embers compared to the $8.2 trillion of local government financing vehicles outstanding. How do they have such a disparity in how much local government financing is outstanding? Wait, how are they reporting to the Reuters article? That's literally the one that I was just looking at, but it says 3. That doesn't make sense. The Reuters article says $3.97 trillion with plus hidden debt. Oh, here. Nomura estimated in a note that local government debt reached 45 trillion yuan. Okay, so 45 divided by 6.48. That's 6.94. 6.94 plus. Well, that doesn't make sense either. 6.94 plus 3.97. Yeah, see, that wouldn't make sense if you added those together. Where did they get this from? Where did they get $8.2 trillion worth of local government financing outstanding? I don't get it. Yeah, that doesn't make sense to me. And I mean, I trust Reuters more than I trust Forbes. Local government debt stood at 3.9 trillion the end of 2020. But then there could be hidden debt. All right, well, they're not making it clear. The CCP made it up, says someone. Because it's all a lie. Oh, gosh. Yeah. All right, let's do a quick look at the sticks, and then we'll come back. I want to explore. I want to understand this a little bit more. Yeah. Okay. Let's see here. I'm going to write this down. It's LGFV. Okay. All right, let's go to the sticks again here for a moment. So crypto. You know, what's fascinating is it looks like Cardano took a little bit longer to catch up with this rally in BTC, and it's actually not rallying as much. Cardano has been a little bit more of a flatliner here ever since really the hard fork on smart contracts. I'm sorry, not hard fork. It's the system-wide upgrade. I suppose that'd be a fork. Yeah, would it be considered a fork? Is the let me see here. Cardano. No, it was a hard fork. Of course it was. It was the smart contract hard fork. And wasn't it Alonzo? I haven't looked into it this in a couple weeks here. Alonzo hard fork on Saturday. Yeah, the Alonzo hard fork. It was a hard fork. Okay, got it. And that was on September 15th. And what's interesting is you kind of had a drawdown in Cardano leading up to September 15th. And it's kind of been rotating down since then. And so I wonder if this was sort of a catalyst point to where traders were trading out of it before that catalyst point and afterwards. So I find that interesting that Cardano has been a little bit of a laggard. But then again, it's also done substantially. I mean, it's done incredibly here since the lows, which we bought some of these lows, quite a few of these lows actually. Most of the buying was done over here. Remember, of course, anytime I send buy or sell, or anytime I buy or sell anything, I send alerts in the Stocks and Psychology Money Group. Check out that link down below in the bundle coupons. For the other programs as well. Most common is people getting real estate investing and Stocks and Psychology of Money. But and then some people will add the property management or something else. But anyway, this is certainly in defiance to the pattern that we've seen at Ethereum or Bitcoin, where you have a little bit more of a push to the upside here more recently. But in Cardano, you sort of had that front loaded. Sitting at 54,000 right now on Bitcoin, kind of drawing down a little bit here after some of this breakout that we saw. Okay, so let's see here. Affirm 3.55. It's pretty cool to see really just Affirm go from in the toilet at open, you know, it was down 2.5% to up 3.3%. I mean, that's a 5% swing here. So we've really had some recovery here. Cloudflare, nice as well, up a couple percent. Zillow coming up. EXPI coming up. Looking to the downside, it looks like you have TMC Metals, Camber getting worse. Spirit Airlines, really the airlines getting whacked here. Why are the airlines getting hit so hard? It's probably because of fuel costs. That's the only thing I could really assume. Let's see here. I'll go ahead and log into the term. We'll see if we can learn a little bit more. All right. All right. Let's see what we have here. SYAB. All right. So pulling this up. In the meantime, it looks like Steve here is trying to get some of the numbers together. Thank you for that. So you mentioned Cities and provinces sold about 1.9 trillion of refinancing bonds in the first 6 months, but refinancing just replaces old debt with new debt. So I don't know that that's really going to increase the number. Yeah, I do think it's the fuel costs on the airlines, but we're going to find out exactly why the airlines are falling. Let's do that together here. American Airlines, let's see here. All right, let's see here. So JetBlue and American Airlines shares slide as Goldman cuts ratings and targets. I see. U.S. daily traffic fell 25% yesterday. Why was yesterday such a slow day? Wow. It actually says here, American Airlines downgraded to a sell from neutral at Goldman Sachs. Well, there's your rationale in terms of why the airlines are going down. They're getting ratings cuts. Yeah. I look into American Lithium. Gosh, yeah, I just don't know much about the mining companies at all. It's really mining and extraction. Updates on projects and development. Let's see what they're up to. So, oh, it's a Canadian company. Okay. So, Big Smoky Crescent Dunes acquisition closed. Drill up to 15 new holes to test high-grade target areas. Recently acquired land in Nevada. Reverse circulation drills to be mobilized in 2 to 3 weeks. Plans to twin. Jeez. Exploration drilling commenced. Gosh, there's a lot to know about mining. I'm like the furthest from somebody knowledgeable about mining, and I don't know much about commodities. So I try to stay away from this. I'm interested to learn more, but I mean, I don't know what you expect me to tell you when you ask me in a super chat here for $7 Canadian. What my thoughts are. Sorry. But anyway, let's go back to some of the sticks here. Okay, so Faraday Futures. Yeah, look at the smaller caps here getting wrecked. Beachbody, Spirit Air. Here are the airlines. We talked about the airlines. Root down 4.24%. Faraday Futures, Camber, Workhorse. A lot of pain over here. I mean, some incredible pain at these companies. Recovery stocks like Cheesecake also rotating down. Makes me wonder, these smaller companies here, why the market is punishing us so badly. Look at Root, for example. Root, when it IPO'd, ran up to $29. Now it's at $4. Like, how does the market misprice that badly? That's incredible. It's just momentum bleed out is really what it is. AMC down 3%. What's AMC now? AMC sitting at $36. Canoe is sitting at $6.66. MP Material, $31. Let's see what else. Bed Bath & Beyond's down a little bit. Wynn Resorts back to 83. Where's good old Wayfair? Look at that one. Wayfair's down 1.7. Nvidia's down 1. Autodesk is down. Neo's down again. Neo was green. What happened? Did we just go red again? Let's see here. Oh my gosh. Look at the S&P 500, folks. Like, this is like clickbait. It's, you literally have a red open, 15-minute rally, and then a collapse. What's crypto doing? It's also drawing down. A little bit more of a bleed pattern here. Let me see here. So U.S. stocks became cheaper this year as prices climbed to records, and even more so when the rally faltered during this past month. S&P 500's 12-month forward PE ratio stood at 21.5. It peaked on September 2nd at 22.6. Oh, I'm sorry. No. It peaked higher than that. It peaked at closer to over 23, which was up from the start of the year when we started at about... this article is a little funny. Let me see if I can just pull the chart. Yeah, there we go. Okay, here we go. So S&P 500's forward PE, price to earnings ratio, here we go. So start of the year, we were at a forward PE of about, 22.8. And now we sit at 22.2. Here, take a look at this. I'll show you. It's just going to take a second. All right, let's go over here. Okay, this is from Bloomberg. So shout out to Bloomberg. And there we go. The white line is your forward PE ratio for the S&P 500. And you can see that really declining, which really is a sign that things are becoming less expensive. Really, we're on a forward PE ratio because earnings are going up at companies. On a forward PE ratio, you're really buying for somewhere around, what levels are those? Those levels are April of 2020. May of 2020. May 1st of 2020 levels. Really? May 1st to May 15th, 2020 on a forward PE chart. That's fascinating. Oh, I like that. It's like a forward PE collapse. Okay. Well, that's an interesting way to look at the market. It's still burning a little bit. Bitcoin and a swap. Inflation expectations now leading yields higher. Is that true, though? Are we actually going up on yields? Let me see here. 10-year Treasury. No, it's still stable around the 1.51. And let's look at the SPY again here. Okay, so now it's recovering again. Boy, oh boy, this is like just the weirdest market. Let me see. I'm just going to go to sort by names here, and let's look at some of these. Airbnb 164. Affirm is still positive at 113. Amazon's down to 3,200. Google's at 27. Apple at 138. Wow, Apple back into the 130s. AMC 36. Looking for some deals. Chipotle 1881, rotating down a little bit. Canadian Solar. Whoa. Hold on a second here. Canadian Solar. Oh, yeah. Look at Canadian Solar's drawdown here. Wow. Look at that. Canadian Solar is selling for September. No, I'm sorry. 31 for Canadian Solar right now is selling for around, September of 2020 pricing. Oh my gosh. That's cheap. I'm going to write this one down. I'm going to see what's up with it. I wonder if it's Chinese competition really hurting this one. But then I wonder how DQ's doing. We'll look at them in a moment. ChargePoint, and look at ChargePoint too. ChargePoint just got wrecked. I mean, it fell well under 20. Carnival Cruise Lines rotating back down. Dutch Bros, Dave & Buster's, DocuSign. Yeah, DocuSign moving down slightly as well. I did have a rally yesterday. EXPI, Etsy, 203. Where's DQ? Now DQ's down about 4% as well, so solar is getting burned a little bit. Which probably means Enphase is down. It is, but it's at 146. Okay, so it was not down as much as it was this morning. Facebook down a bit. GameStop down 264. Gevo down 4. Hippo down 3.54. Matterport 1794. Nike. Trying to find, just see. Yeah, I mean, Neo is just by far one of those that really sits here and stands out. But this Chinese municipal debt, that's an interesting one. I really want to dive into that. Palantir's 5%, but it's really only up 5% because it was up as much as 13% yesterday in the post market. Robinhood's still sitting at 42. It's really tethered here. SoFi 16. SoFi's keeping it up a little better. Tesla's down 0.62. Trade Desk 67. We've been downtrending on this one too. So I'm really watching this to see when this breaks to either side. Wynn Resorts. Yeah, okay. And then Disney down 1.31. Let's see what if anyone's saying anything on this. Let's go to Bloomberg again. Bloomberg or even the Wall Street Journal. Let's try here. Stocks open lower and fresh sell-off on Wall Street. Student loan forgiveness to include. Okay, let's see what Wall Street has. Oh yeah, and then let's also look at SHIB because we have had CoinMarketCap. We've had a crypto rise nicely here. Bitcoin's done great. Let's look at how SHIB's been. Still running. I mean, it's incredible. Yesterday was a great day for SHIB. I mean, you went up substantially yesterday, and the run is really continuing. Pretty cool. Okay. Yeah, and especially with uncertainty in the market, I feel like it's easier for traders to potentially consolidate around something else like SHIB. Got to post my SHIB video. That reminds me. Got to get that. All right. So, golly, fascinating market. Really fascinating market. And we've got a lot of unanswered questions. And these are things that I want to make videos on. So I want to find out what I can about the Chinese municipal debt. We want to find out about why solar is collapsing. And we want to also find out why or some of the differences between really understanding some of the historical implications of acyclical versus cyclical inflation. It's going to be interesting to see what we had in the 70s. My guess is more cyclical inflation. But a rise in acyclical. Acyclical. Yeah. And then again, acyclical include that are more sensitive to industry-specific factors. And this rise in healthcare costs here is very interesting because that bumps services, but then you have non-healthcare. Oh, I can remove it. Oh, how cool. Healthcare actually hasn't moved much because if I move that, there, it's the non-healthcare services. Non-healthcare services. Ah, there we go. Non-healthcare services are bumping. That's what they're showing. Okay. But then you also have this broader undertone of sort of the entire economy moving to the upside, or entire economic inflation moving to the upside. Because this is really the inflation levels. This is really what's contributing to it. And you have more service sector items contributing to inflation, presumably both types. Yeah, but you still have that inflection to the downside there. A cyclical contribution. How does this go down when this is stable? That I don't understand. That's weird to me. But anyway, we have a course member live stream to go to, and I appreciate you all being here. Thank you so much. Make sure to get your free stock worth up to $70 with Public, and we'll try to understand what the craziness is that's going on in the markets, and stay tuned for more videos on that. So thank you so much for watching, and folks, we'll see you in the next one. Bye.